Have you ever stopped to ask yourself, what would my life look like if I start investing now, rather than waiting till I'm older? Well, let's delve into that question today. Financial security is a common goal for many of us, and investing plays a vital role in achieving this. It's not just about accumulating wealth, but also about securing your future and creating a safety net for unforeseen circumstances. Now, let's talk about why it's so important to start investing at an early age. Think of it like planting a seed. The earlier you plant it, the more time it has to grow. Similarly, the earlier you start investing, the more time your money has to multiply. One of the most powerful tools in investing is compound interest. This is the process where you earn interest on your initial investment. And then you earn interest on that interest. Over time, this snowball effect can lead to significant growth. For example, if you were to invest $1,000 at an interest rate of 5% per year, after 20 years, thanks to the magic of compound interest, your investment would have grown to approximately $2,700. Now, imagine you started investing in your 20s instead of your 40s. That's an extra 20 years of growth, an extra 20 years of compound interest. You see, in the world of investing, time is a valuable asset. Every moment you delay investing is a missed opportunity for your money to grow. However, starting early doesn't mean you should dive in without a plan. It's essential to educate yourself about different investment options, understand their risks and rewards, and create a strategy that aligns with your financial goals. And we'll delve into these topics in the following scenes. So, if you're looking for a secure future and financial freedom, the time to start investing is now. With the decision to invest comes the question, where do I put my money? Well, the financial world offers a variety of investment options, each with its unique features, benefits, and risks. Today we'll focus on two popular choices: stocks and exchange-traded funds, or ETFs for short. Let's start with stocks. When you buy a stock, you're buying a piece of a company. Yes, you heard right. You become a shareholder, and as the company grows and thrives, so does your investment. Sounds enticing, doesn't it? But remember, the stock market can be unpredictable. The company you invest in may face challenges, and its stock price might drop. So, while stocks can offer high returns, they also come with a certain level of risk. Now let's talk about ETFs. An ETF is a type of fund that holds multiple assets such as stocks, bonds, or commodities. When you invest in an ETF, you're investing in a diversified portfolio, not just a single company. This can help spread out the risk. If one company in the fund performs poorly, others might do well, balancing out your overall returns. ETFs also offer flexibility, as they can be bought and sold throughout the trading day at market price, much like individual stocks. So, should you choose stocks or ETFs? Well, it's not necessarily an either-or decision. Many successful investors have a mix of both in their portfolio. This approach, known as diversification, can help to spread risk and potentially increase your chances of earning a return. Remember, investing isn't about quick wins. It's about long-term growth and building wealth over time. Therefore, it's important to understand the nature of your investment options and think carefully about your financial goals, risk tolerance, and time horizon before making a decision. To make a wise investment decision, understanding your options and weighing the risks against potential rewards is crucial. So, take your time, do your research, and don't be afraid to seek guidance from financial advisors or investment professionals. After all, your financial future is at stake. Now that you know why and where to invest, the next question is, how do I start? Well, it's quite simple, really. Let's break it down into manageable steps. First off, you need to start saving money. It might sound basic, but it's an essential first step. You'll need funds to invest, and these come from saving a portion of your income. Be disciplined in setting aside a specific amount each month. It doesn't have to be a large amount. What's important is consistency. Once you've accumulated some savings, the next step is to open an investment account. You can do this through a brokerage firm, a robo-advisor, or even your bank. Each has its pros and cons, so choose the one that suits your needs and comfort level. Now, with your account set up and your savings in place, you're ready to choose your investments. Remember, we talked about different options like stocks and ETFs? This is where you put that knowledge to use. You can choose to invest in a single company's stock, a group of stocks through an ETF, or a mix of both. Your choice should align with your financial goals and risk tolerance. But investing isn't a one-and-done deal. You've got to regularly review and adjust your investment portfolio. The market changes, and so should your investments. Keep an eye on your portfolio's performance. If some investments aren't doing well, don't be afraid to let them go. On the other hand, if certain investments are performing well, consider adding more to them. Throughout this process, remember that discipline and consistency are key. You're not going to see massive returns overnight. It takes time for investments to yield substantial returns. Remember, investing isn't a get-rich-quick scheme. It's a long-term strategy that requires patience and discipline. As a new investor, you might wonder, what strategies should I follow? Well, let's delve into some beginner-friendly investment strategies that can help you start building wealth. First off, consider the strategy of dollar-cost averaging. This involves investing a specific amount of money at regular intervals, such as monthly or quarterly, regardless of the market's performance. This method can be quite beneficial, as it helps to reduce the impact of market volatility and lowers the risk of making a large investment when the market is at its peak. Another strategy that you might find useful is investing in low-cost index funds. These are funds that track the performance of a specific market index, like the S&P 500. The beauty of index funds is that they offer broad market exposure, low operating expenses, and low portfolio turnover. They're essentially a way to invest in the entire market, rather than picking and choosing individual stocks, which can be a more risky strategy. Now, as you embark on your investment journey, it's essential to have a clear investment goal. What are you investing for? A down payment on a house, your child's college education, or perhaps your retirement? Having a clear goal will help guide your investment decisions and keep you focused. Moreover, once you've started investing, it's important to stick to your investment plan. The market will have its ups and downs, but don't let these short-term fluctuations sway you. Remember, investing is a long-term game. It's about building wealth over time, not overnight. Lastly, it's worth mentioning the importance of diversification. This means spreading your investments across different types of securities to reduce risk. You don't want to put all your eggs in one basket, as they say. Diversification can help ensure that a decline in one particular investment won't have a devastating impact on your overall portfolio. No matter what strategy you choose, the key is to stay focused on your financial goals and not let short-term market fluctuations distract you. So, what have we learned today about building generational wealth and securing our future? We've discovered that the power of early investment cannot be overstated. Starting as young as possible helps us take advantage of the magic of compound interest. Remember, it's not about timing the market, but time in the market that counts. The sooner we start, the more time our money has to grow. We've explored the different investment options available to us. Stocks represent a share in the ownership of a company and constitute a claim on part of the company's assets and earnings. They can be a great way to grow wealth over time, but they also come with their fair share of risks. On the other hand, exchange-traded funds or ETFs offer a way to invest in a diversified portfolio of assets. They can track an index, a commodity, bonds, or a basket of assets. ETFs provide the diversification of mutual funds with the flexibility of stocks, making them a popular choice for many investors. Next, we've delved into the process of investing. We've learned it's not just about picking the right stocks or ETFs, but also about understanding our risk tolerance, setting clear financial goals, and consistently contributing to our investments. It's a long-term game, and patience is key. And finally, we've discussed some beginner-friendly investment strategies. Dollar-cost averaging, where we invest a fixed amount of money at regular intervals regardless of the market conditions, can help mitigate risk. Diversification, or spreading our investments across a variety of assets, can also help protect us from volatility in any one area. And never forget the importance of continually educating ourselves about the market and our investment options. Investing early and wisely can set you on a path towards financial security and freedom. So, why wait? Start your investment journey today.